friends, I'm Untitled Chapter and I'm back with yet another video. Today we will be talking about mutual fund versus stocks. किसमें आपको ज़्यादा फायदा होता है and investment in which vehicle gives you more return and more secured returns. We will all discuss about that. Let us start the video. What are mutual funds? Mutual fund means my fund, your fund, mutual fund. It means that your fund is managed by a group of fund managers who are managing the funds of say 1 lakh people. 1 lakh people, everyone contributes rupees 1000 per month. So here's a net corpus of rupees 10 crores. Now there are several advantages and disadvantages with respect to investment in mutual funds, and we would be discussing about the pros and cons of mutual fund investment over and above investment in stock market. Let us start the video. Number 1, advantages of mutual fund investment. Point number 1, investment through professional hands. You are having a chauffeur who is driving your car, so this car doesn't have accidents. You reach your destination in time. It means that you have safe returns, your risks are mitigated, your funds values do not decrease when the market crashes down, because your fund is diversified in several sectors across large cap, small cap and mid cap stocks, and across good companies which are analyzed and subsequently researched by the fund managers. Number 2 point is mitigation of losses through diversification. When Bank Nifty crashed from say 40,000 to 34,000, or say our Nifty crashed from 16,800 to say 16,200, it crashed even from 18,000 levels from March end. So that time, when you have a war situation, you have an inflation hit economy, a recession based economy, still your mutual fund haven't yielded that much negative returns as your stock have yielded had you bought the stock at that time, because there are always some stocks in some sectors which are performing. So you have an additional cushion or a little bit of protection against your coverage, because all your eggs are not in one basket. Number 3 advantage of mutual fund investing are investment in expensive stocks. For example, if I want to buy MRF, it costs me around 70,000 to 80,000 rupees per stock. I want to buy Maruti, 25,000. Say Eicher Motors, it's also beyond 10,000. So if I have a corpus of say 5,000, 6,000, what do? I can invest 1,000 rupees, and as I told, the 1,000 from all those investors at 10 crore rupees, it is all diversified into Maruti Suzuki, Reliance, HDFC, TCS, Eicher Motors, all the high value stocks across sectors, say banking sector, insurance sector, services sector, FMCG sector, everywhere, electronics, real estate, whatever you want to figure out, everything is diversified and you have investment in all your categories. So if a sector is specifically hit by recession, you do not suffer that much losses. Now 4th point is that it is a good thing for salaried people who are having stable cash flows. I know I have a salary of 30,000, say 20,000 per month. So I can invest 1,000 or 2,000 in SIP for HDFC Top 100. I go for 1,000 SIP in Axis Blue Chip, and so I count that 3,000 rupees every month. After 6 months or 8 months, I visit my portfolio and see what appreciation or what returns I have got, the net position I have seen. So apart from these 4 advantages in mutual fund, I would say the advantage is in psychology. For people who cannot take losses, who cannot see their portfolio in red, they should go for mutual fund investing. But there are also disadvantages in the same, and why people should invest in stocks over and above mutual funds. Number 1 advantage, sacrificing profits when the market goes up. There would be situations when your Bank Nifty will correct, your market will correct, you will have 1,000, 1,500 point move, and that particular year when you saw that your Bank Nifty moved 15, 20, 30%, when your stock, say HUL, say Reliance, say TCS, the good high value stocks, say Indiabulls Housing Finance who manage debt very properly, these stocks yield you 20, 30% returns. Your maybe HDFC Top 100, your Blue Chip, your Canara Robeco, or your Contra Fund, maybe they have yielded you a lower amount of return. They have given you maybe 10%, 12%. So basically you are sacrificing your profit when you are going for mutual fund in this case. Historical profit figures can be very, very deceptive. If I tell you that my HDFC Top 100 fund has performed 15%, 20%, my Mirae Asset Hybrid Equity Fund has performed 30% over financial year 20, it doesn't mean it will perform 25% in financial year 21. Even it can come at a loss. Even you may see that maybe other funds have far better performed than your particular fund. This is because new funds are introduced everywhere. There is diversification. There are open-ended, closed-ended funds, equity-based fund, hybrid funds, debt fund, plethora of products which all have different meanings, different financial implications. They may be introduced in the market. Fund managers may alter and switch between funds so that they give, because at the end of the day they also have to give returns to all their clients. So in order to maximize your returns, you may actually go against it and reduce your returns over that period of time. Number 3, there are funds with high expense ratio and exit load. So what is an expense ratio? That charge that you pay to your fund managers. So maybe the fund has given you 15% returns, but at the end of the day you receive 10% or 11% because 4% you are paying for that fund. Okay, because it is a good fund, it is managed by expert hands. So you should always see the expense ratio before you go for investment. And also the exit load. For example, there are some funds, if you exit within 1 year, say I pay 2,000 for 10 months and then I need money, so I have to liquidate those 20,000 rupees. Then I see when my return is 15% or 13% showing, it is giving me 11% return. Maybe there is an exit load of 1%, 2%, 3%. So that is an extra cost over and above my expense ratio that I have to bear because I am liquidating in the time, which is not there in stocks. You can liquidate on the day in an intraday trading, or you can liquidate at any point of time that you wish to. Number 4, liquidation comes at a cost. You say, I talked about the expense ratio, I talked about the exit load. At the end of the day, you would also visit and you would think that had I diversified my funds, my little funds, and invested in 2 or 3 stocks, maybe not many stocks because my fund value is 5,000, 8,000, I could have incurred some profits and it could have come very fast. In mutual fund, it is growing very slowly. It is growing over a period of time. I am having expense ratio. I am having to pay the fund managers. I am having to pay my exit load in case I exit in time. There are so many obligations, so many things which stops you from making a lot of money in mutual funds. So at that time, you may think that reading the balance sheet, PL accounts, tracking the news, getting some insights from the market, and maybe analyzing your own could be much more beneficial, especially with now discount brokers coming in, which preferably give you the option of buying stocks at just about zero or just a very negligible value. So I talked about 4 advantages and 4 disadvantages of investment in mutual fund over stocks. Always remember, in investment there is one simple word: do not put all eggs in one basket. If I talk about options video in my previous video, it also comes with a cost because it is a high risk trading. Mutual fund comes over a high range, high period of time that you need. So in a nutshell, there are always pros and cons of investment in mutual funds over and above stocks. Both are beneficial. They have own advantages and disadvantages. Should take a decision depending on your risk appetite, depending on your financial position. But definitely, mutual funds are beneficial. Mutual funds sahi hai, and you should make your own financing decisions. For queries or anything that you want me to explain, please do contact. Thank you.